It's a quiet Wednesday evening, and the numbers on the laptop glow harder than the dishwasher in the background. A six-figure household sits at the dining table surrounded by bills, trying to understand why stability feels like an illusion. Together, they earn $120,000 a year, a number that once symbolized comfort, yet one unexpected repair could push them onto a credit card. They redo the math again and again, hoping for a mistake, but before vacations, real retirement savings, or small luxuries, more than $36,000 is already gone. The pressure doesn't come from overspending, it comes from structure. We follow the Parkers, a middle-class family that appears successful on paper. Emily earns $70,000 in project management. Jason earns $50,000 in network support. 2 kids, a modest home, used cars, stable careers. By income statistics, they're above average. By lived experience, they're awake at 1 a.m. calculating. Jason's first paycheck of the year shows how fast money disappears, nearly 25% removed instantly through federal tax, Social Security, Medicare, state tax, and health insurance. Emily's deductions are even larger. Across the year, their $120,000 shrinks to roughly $88,900 after payroll taxes and premiums. The headline salary was never truly theirs. Then come the layered obligations. Property taxes add $5,100 annually, pushing their housing cost to $2,725 per month with the mortgage. Tax season brings a temporary refund, but it simply patches prior damage. Credit card balances from heating spikes and holiday travel, overdue bills, and small postponed expenses. The refund feels like relief for 2 days before dissolving into necessity. State taxes barely return anything meaningful. Meanwhile, FICA contributions of over $9,000 vanish into a future promise decades away. When Jason totals everything, federal, state, FICA, property tax, and health insurance, the number hits $43,344. Over 36% of their gross income disappears before groceries, childcare, gas, utilities, or basic living costs even begin. The tightening isn't dramatic, it's quiet, systematic, and relentless. This story reveals how a 6-figure income can still feel fragile, not because of reckless spending, but because structural deductions and fixed costs steadily compress what remains, turning financial stability into a constant balancing act. Daycare is the next pressure point. Their youngest attends a licensed center costing $1,050 per month. That's $12,600 annually, more than their grocery budget. They briefly consider one parent staying home, but losing $50,000 in salary to avoid $12,600 in childcare doesn't make financial sense. Summer camps for the older child add another $1,800 across June and July. Child-related expenses alone approach $14,400 before counting clothes, birthday parties, or school fundraisers. The cost isn't dramatic in a single moment, it's relentless in accumulation. April brings vehicle renewals. Insurance for 2 used cars totals $2,940 per year. Registration and inspections add $420. Gas averages $320 per month, or $3,840 annually. Routine maintenance, oil changes, brake pads, one unexpected alternator replacement pushes total transportation costs above $8,000 for the year. Reliable cars are cheaper than new ones, but they are not free to operate. Utilities layer in quietly. Electricity averages $210 per month across seasons. Water and sewer add $95. Internet is $80. 2 cell phone lines cost $150. Streaming subscriptions and small digital services creep up to $65. Combined, basic utilities reach roughly $600 per month, or $7,200 per year. None of it feels optional in isolation. Together, it absorbs another significant portion of cash flow. Groceries fluctuate with inflation and growing children. Their average monthly spend settles around $850, totaling $10,200 annually. They attempt bulk buying and coupon apps, but rising food costs erase most efficiency gains. Occasional dining out, modest restaurants, not luxury, adds $2,400 over the year. Food at home and outside crosses $12,500. By mid-year, Jason tracks fixed and semi-fixed obligations, housing at $32,700 including property tax, childcare near $14,200, transportation above $8,000, utilities around $7,200, groceries and dining near $12,500, insurance premiums already counted at $14,352 through payroll, federal, state, and FICA taxes at $23,892 combined, property tax $5,100 already listed within housing. The running total approaches the high $80,000 range in required outflow against roughly $88,900 in net income. Margin narrows to almost nothing. Then life happens. A dental procedure insurance only partially covers, costs $1,300 out of pocket. A minor emergency room visit after a playground accident adds $900. The HVAC system needs a capacitor replacement for $650. None of these are catastrophic. Together, they consume the small buffer they were trying to build. By September, their emergency fund dips back below $1,500. Retirement contributions exist but are minimal. Each contributes just enough to capture employer match, 4% from Jason, 5% from Emily. Combined annual contributions, including employer match, total roughly $10,000. It sounds responsible, yet replacing their income in retirement would require well over $1.5 million invested using a 4% withdrawal framework. At their current savings rate, that horizon stretches decades. By October, they review the numbers again. Gross income still reads $120,000, but after mandatory deductions and necessary living costs, discretionary flexibility averages less than $400 per month, and that's before irregular expenses. The psychological weight doesn't come from extravagance, it comes from realizing that a six-figure income can still function like a narrow bridge, stable as long as nothing shakes it. When November arrives with higher heating bills and holiday travel planning, the credit card balance begins rising again, not because they are reckless, because the structure was thin from the beginning. November spending exposes the structural weakness. Heating costs jump to $360. Holiday travel for four, booked modestly and in advance, still totals $1,400 between flights and fuel. Gifts, even restrained, add $900. December groceries rise another $250 hosting extended family. By year-end, the credit card balance quietly reaches $3,800. At nearly 20% APR, interest alone approaches $760 annually if left revolving. What looked like small seasonal generosity becomes long-term drag. In January, they sit down again, this time not to survive the month, but to dissect the system. The core issue isn't recklessness, it's structural compression. Their fixed commitments are too high relative to take-home pay. Housing consumes over a third of net income. Childcare rivals a second mortgage. Taxes and payroll deductions are immovable. The remaining categories, food, utilities, transport, are necessary for functioning. The budget isn't bloated, it's tight. They test scenarios. If they moved to a slightly smaller home and reduced the mortgage by $400 per month, that would free $4,800 per year. Refinancing isn't viable at current rates, but relocating at lease renewal might be. If Jason negotiated remote work 2 days per week, fuel and maintenance could drop by $1,200 annually. If raises came, they agree in advance to split them, 70% towards debt reduction or investments, 30% towards lifestyle improvements. Without a rule, income expands expenses automatically. With a rule, income builds margin. They analyze debt first. Paying off the $3,800 credit card balance yields a guaranteed 20% return by eliminating interest. That becomes priority one. Next is building a 6-month emergency fund. Their core monthly expenses average about $7,000. 6 months would require $42,000, a number that initially feels impossible. So they reverse engineer it. $800 per month saved consistently would reach $9,600 per year. In 4 to 5 years, fully funded. Not instant relief, but structural stability. Retirement math reframes their thinking. Using the 4% guideline, every $25 invested can generate roughly $1 of sustainable annual income. If they eventually want $80,000 per year without employment, they would need about $2 million invested. The number is intimidating, but it converts vague hope into a measurable target. At a combined $10,000 annual contribution growing at long-term market averages, compounding over 25 to 30 years becomes powerful. Increasing contributions by even 2% of income accelerates that timeline significantly. They also reconsider spending categories that don't increase life satisfaction. Research consistently shows that money spent reducing daily stress, like outsourcing occasional deep cleaning or shortening commutes, produces more lasting happiness than status purchases. They cancel 2 unused subscriptions, downgrade a phone plan, and redirect $140 monthly straight into savings. Small adjustments, but automated. Automation removes willpower from the equation. By spring, something subtle changes. The numbers haven't dramatically improved yet, but direction has. The credit card balance falls steadily, savings rise predictably, raises are pre-allocated before they arrive. Instead of reacting to expenses, they're anticipating them. The anxiety doesn't disappear overnight, but it softens. They realize the pressure wasn't caused by earning too little for their demographic. It was caused by having no structural buffer between income and obligation.